In this session, let's start looking at one of the innovations of the modern day world, which are nothing but the credit default swaps. Though they are called as swaps, what I could really see is they have a lot of option like characteristics, or probably they have a lot of insurance like characteristics. So they are really one of the wonderful financial innovations in the modern day world. So we would like to see how these credit default swap work, and what would be the typical pricing and valuation mechanism involved with the credit default swaps, so that we can very well understand how they have become one of the key tools in the current financial markets. So, as an introduction to the same, the way I would look at a credit default swap as a primary insurance contract. Why to look at it as an insurance contract? What do we do generally in an insurance? Every period we keep paying premiums for some uncertain event, right? For some uncertain event, thinking that that particular uncertain event, whenever it occurs, it will create in a financial loss. We are trying to transfer that loss to a risk taking entity called as insurance company, with an agreement that in case the loss occurs, the insurance company will be replenishing the loss for this particular party, whichever will experience the loss. So there may be a payment from the insurance company to the party, or they may not be. Means the payment from one party is contingent to a loss. Only if the loss occurs, then only the payment will be made. Whereas from the other party, regularly in the form of premiums, there is a regular payment. This is how a typical insurance contract works, right? And what I see is a lot of similarities in the credit default swap contract also. So just to illustrate the credit default swap at a very premier level, at a very preliminary level, the way I look at it is, assume that there is a loan. X has taken a loan from Y. Now because X has taken a loan from Y, X has to repay the loan. So Y is exposed to a credit risk. What is the credit risk here? X may not be able to repay the principal and or interest on that particular loan. So the way what Y could do is, Y could take a protection against X by entering into a credit default swap with some other party Z. So Y will take a protection on the payments of X with another party Z, and the protection is like this: in case X is not able to pay the loan, Z will replenish Y with the loan, with the amount. Z will replenish Y with the amount. But of course, for providing such a kind of a service, Y has to regularly keep paying a premium to Z, and in case this default occurs, Z will be responsible for replenishing the loss which Y is occurring, which Y is incurring because of the default of X. That's the typical structure of a credit default swap. So the underlying is a default on a loan or a bond. Even in the bond the payments are like that only. Let's say X has purchased a bond from Y. So Y is the issuer of the bond and X is the investor in the bond. So X is exposed to risk. That what if Y does not pay the coupons, or what if Y does not pay the principal as per the schedule. So to protect itself from that kind of a default, X may enter into a product called credit default swap with Z. Z may be the seller of the credit default swap, whereas X may be the buyer of the credit default swap. So as a buyer, the X is buying a protection against the default of Y, whereas Z is selling protection against the default of Y. Means if Y defaults, Z says I am there. Whereas for X is trying to make sure that he is not losing because Y is defaulting. This is what is the transaction that typically happens in a credit default swap. So the buyer pays a premium to the protection seller, generally against the default of a third party, and this third party is what we actually call as a reference entity. The third party Y in this example I call as a reference entity, and generally it would be a senior unsecured kind of a loan. Or if I am talking about the company which is issuing it, we call it reference entity. That particular loan is called as reference obligation, just using some of the terms which go as a part of the credit default swap. Reference obligation, and generally the obligation is a senior unsecured loan. And now if we see one more dimension to it, the credit protection buyer is always short on the reference entity's credit. Means he is always bearish on the reference entity's credit. So that's where he want to take a protection. Why? What is meant by short? He will get a benefit when the reference entity defaults. He will get a benefit when the reference entity's credit position goes very bad. Whereas Z, who is selling the credit protection, he is bullish on the financial condition of the reference entity, because Z is saying if the Y is defaulting, I will protect you against it. Means in a thought process, the protection seller is really bullish about the performance of the reference entity. So this is how we see a credit default swap working, especially against the default of a third party. Party 1 and party 2 are getting into a kind of a contract wherein party 2 will address the loss faced by party 1 because of the default of the third party. That is the typical transaction of a credit default swap. Now, generally we see two major categories of credit default swap. One is a single name CDS, the other is an index CDS. So in a single name CDS, we generally see that the reference obligation is just a single fixed income security, one single loan or one single bond. So it's a single fixed income security issued by one single entity. So when that entity defaults, whatever is the security that we have fixed, when that entity defaults, the payment would be done for this particular security as well as any other securities which are ranked better than this also, which are more senior to this also. So the simple intention in the process is, whenever I am naming a single name CDS, the focus is on a single fixed income security. Whereas when we talk about index CDS, it's like index of so many securities. And generally whatever is the payoff, it is based on the notional principal minus the market value of the cheapest to deliver kind of a bond. The simple logic. Okay, let's say A has entered into a credit default swap with B on C's bonds, where the issuer is C. A is a buyer of the credit default swap and C is the seller of the protection, and B is the seller of the protection. Let's assume that the notional principal is $1 million. And let's say corresponding to this C, there are two unsecured bonds that are traded in the market, and both of them are senior. One is getting traded at 25% and the other is getting traded at 30%. So the cheapest to deliver primarily is the one that is getting traded at this 25% itself. Now what the payoff that would be done in this regard in case the default occurs is the notional principal, whatever is 1 million, minus, even if they are subordinate kind of debts and all, I will not bother about the subordinate kind of debts and all, right? So the cheapest to deliver bond here is 25%, is trading at 25% of the par value. So whenever I am talking about the payoff that would be incurred in case there is a default, 1 million minus 25% of 1 million, working out to 0.75 million. 0.75 million is what is the payoff in case of a default. This is the scenario that happens in case of single name CDS. Only when there is a default of that particular reference entity, we talk about the payoff, and that payoff is based with respect to the cheapest to deliver bond in respect to seniority, which is having the same seniority as the reference obligation. So if the reference obligation is a senior debt, even the CDS which I would be looking at is with respect to the similar levels of seniority with respect to the reference obligation. Now, apart from the single name CDS, we can talk about an index CDS, which is the grouping of various reference entities or various loans together as a package. So just like an index on a stock. So all these loans are packaged together as an index for some notional principal. So probably if I say the notional principal is $100 million, the notional principal is $100 million and there are 100 entities or 100 loans that are packaged together in this. Then typically the reference obligation, the notional principal for each reference obligation is equally divided. So basically $1 million will be the notional principal for each reference obligation. So let's assume that out of these 100 entities, one entity has defaulted and its CTD is trading at 30% to the par value. This is actually giving me that for this $1 million, the payoff is going to be 30% lesser to this 1 million, giving rise to 0.7 million or 700,000 would be the payment that would be made in case of the default of this particular one entity. Whereas one thing that needs to be seen here is the CDS will still continue. Here in this case, the CDS will cease to exist because the reference entity has already defaulted. So CDS will cease to exist in this case, so its CDS will be closed. Whereas in this case, the CDS will continue, the credit default swap will continue with 99 entities in the index, and with $99 million being the notional principal of that particular index, and rest all continuing in the same way. The advantage of getting into an index CDS is the constituents of that CDS, right? If they are negatively correlated or probably less positively correlated, the risk involved there is already a portfolio diversification that is happening, and because of that portfolio diversification, the chances of loss of all of them defaulting is very, very less. So that would actually result in a lesser premium. That is one of the prime reasons the index CDS have more value compared to a single name CDS. If at all, let's say there are 10 different borrowers and I want to protect myself from all 10 different borrowers, rather than taking 10 different CDSs separately with 10 different players, I could have easily taken an index CDS which will protect me against all those borrowers. And if the correlation between all those borrowers is not that strongly positive, it may so happen that if one of them have defaulted, very little chance of the other defaulting and vice versa. I would have protected myself to a large extent through that portfolio itself, which means the premium that I need to pay towards the CDS protection would actually go down. But if the constituents are highly positively correlated, then probably that may lead to a higher premium only. But the payoffs, as we have seen, for each of the entities, the notional principal is divided equally among all the entities, and based on the market rate for that particular CDS, the market rate at which that particular CDS is trading, we talk about the payoff value. And typically the common credit event is nothing but whatever is associated in some form or the other with the default. So there is this particular thing is decided by a determination committee of ISDA, wherein it has 15 members and at least 12 of them, means 80% of them, should really appreciate that this is a credit default event, which could be either characterized as bankruptcy, wherein the court intervenes in terms of the settlement process to the creditors, or someone has filed for a bankruptcy protection, means the court will start working out with the company in terms of addressing the needs of the creditors. Then there could be a scenario of the borrower not paying the interest or the principal payments on time, which can be categorized as failure to pay, or in some cases there is a forceful change of terms and conditions by the borrower on the lender. So probably a borrower restructures the terms and conditions of the debt and forces the lender to follow them. Even that would be treated as a credit default event. So any of these credit default events happens, the CDS protection comes into picture. And generally in the CDS protection we talk about either a cash settlement or a physical delivery. when we talk about the physical delivery, let's say the reference obligation, let's say A and B have got into a CDS. A is a buyer of CDS and B is a seller of CDS on the reference obligation C. So let's say if C is defaulted. Now whatever is the notional principal that is there, or whatever is the face value of this particular reference obligation that is there, A will have to surrender the reference obligation to B, wherein B will provide the protection in terms of the notional principal amount. So that is the physical delivery kind of a settlement. So A has to provide the reference obligation, underlying reference obligation to B, the CDS seller, whereas the seller will compensate the buyer with the notional amount. The other kind of settlement that is there is a cash settlement, wherein the payout ratio is determined. Payout ratio is nothing but the 1 minus whatever is the recovery rate. So the recovery rate is again assessed based on the market value of the trade, which is the based on the recovery rate, the cheapest to deliver CDS would be decided, which would constitute your payout ratio, and payout ratio is multiplied by the notional principal based on how much can be recovered from that party, or probably based on the loss given default. That is what would be the payout. So which means A does not need to give B any kind of underlying reference obligation, rather B would be settling A probably only with 70% of the notional principal or 75% of the notional principal, depending on the recovery rate. So this is purely based on the CTD obligation that is associated with the reference entity, which means only after deducting for the market value of the CTD, the settlement for this credit default swap happens if it is a cash based settlement. In some cases, the seller has the option to settle either in the form of cash or in the form of a physical delivery. And how does this CDS pricing typically happen? The major things, when I say pricing, it is more associated with the premium which the CDS protection buyer has to pay to the seller. This is what we call as the pricing of the CDS. So the major factors that play a role in the pricing are with respect to the reference entity or even the reference obligation. We look at what is the probability of default, because once the default occurs, the CDS ceases to exist. So which means just like a life insurance policy, once the death occurs, the policy ceases to exist. Same logic comes in here. Once the default of the company occurs, the CDS seller will compensate the CDS buyer and the CDS is no more applicable. So the higher is the chances of default, higher should be the premium charge, because the default amount could be a very huge amount. So if the probability of default is high, the premium should be higher, because the buyer will keep paying the premiums and seller will do a protection payment. So if the premiums are very low, whereas the chances of default are very high, there will be an uneven payoff between both the parties. The total premiums that are paid could be much lesser, whereas the protection that could be paid is much higher. So if the probability of the default is very high, probably the premium that is charged also should be very high, and vice versa. And generally what we also see is the probability of default increases with time. So today the chances of default may be much lesser, because a lot of credentials, credit quality checks, everything would have been done on that reference obligation as well as the reference entity. But few years down the down the lane, it may so happen that the position of the reference entity or a reference obligation could have gone very bad, which could have resulted in more and more chances of default. So all these things have to be considered when the pricing or the premium is decided for a credit default swap. The other thing that is more important to look at is the hazard rate, wherein the hazard rate talks about what is the, it's basically a conditional probability kind of a situation. What is the chance that this particular reference entity defaults in year x plus 1, default in year x plus 1, given that it has not defaulted in x. This is what is the hazard rate. Now based on this hazard rate only, we compute the premiums, we compute what is called as the expected loss. So along with the hazard rate, the loss given default means in case the default occurs, what is going to be the loss. This is purely based on the recovery rate. In case the entity defaults, so how much proportion of it can be recovered? Can 30% be recovered? Means 70% is the loss given default. If 60% can be recovered from that loan or reference entity, then only 40% is the loss given default. So this is purely inversely proportional to the recovery rate. So if we see, based on the probability of default as well as loss given default, if both these things are higher, it so happens that the protection to be paid, the chances of protection to be paid are very high. So probably the premium that needs to be charged should typically go up. What we generally see in the market is that premium is around 1% of the notional principal for investment grade debt, whereas for junk bonds or high yield bonds, we see that the premiums are charged somewhere around 5% of the notional principal per year. And the expected loss is typically computed as the hazard rate multiplied by loss given default. What is the chance of default this year, given that it has not defaulted in the last year, multiplied by what is the loss in case the default is going to occur. And here, so from one party's side, there are continuous premium payments, and so that this kind of payments are called as a premium leg. All these payments paid by the protection buyer, we call them as premium leg. And on the other side, the benefit that is provided by the CDS seller or protection seller, that is called as a protection leg. So the present value of these two legs is typically computed, and the difference between the two is what we call as the upfront premium. So if the protection leg present value is higher than the premium leg, so that is what we call as the upfront premium. So if it is negative, the buyer will receive the premium, because at the start of the contract, both of them should have equal present value. Anyone is having a higher present value, then that particular party will receive a premium from the other party. So if the difference between the protection leg minus the premium leg is positive, then the CDS seller will receive the premium. Otherwise, if it is negative, then the CDS buyer will receive the premium. And the other way to talk about the premium is CDS spread minus CDS coupon. So what are these two things? CDS spread is the difference between the CDS protection percentage. What is the risk with respect to the underlying entity, wherein you talk about the CDS returns minus the treasury bond with the equal maturity period and all, or risk free kind of a rate, whatever the difference between the two is what we call as a CDS spread, which means that is the extra spread which is typically paid for assuming the risk. So the CDS spread is coming out as the return on the CDS minus the risk-free rate of return for an equal period kind of a security or a treasury bond. And when I am talking about CDS coupon, that is the kind of a premium, because coupon is like a regular payment amount, which is nothing but the premium. The premium which is generally paid by the CDS protection buyer. So the difference between the two every year in terms of percentage. So let's assume that the CDS returns are 6%, risk-free rate of return is 4%. So or probably instead of risk-free rate I may take LIBOR also. So in this case the CDS spread will actually become 2%. And if I say that the CDS protection buyer is paying a coupon of 1%, then value wise 1% is a benefit which goes to the CDS protection seller. So 1% of the notional value, and this is per year. So it multiplied by the duration of CDS, how many years the CDS is available. Now here this number is also a variable, because once the default occurs, this duration will, CDS will cease to exist. I am not looking at the underlying bond here. If the default is occurred, the CDS will cease to exist. So the duration will be only will not be the full period of the bond, right? So the CDS spread minus the CDS coupon multiplied by the duration of the CDS and multiplied by the notional principal is what is the upfront premium. Again, if it is positive, the CDS seller or the protection seller will receive the premium upfront. If it is negative, the CDS buyer or the protection buyer will receive the premium. So whenever we are talking about the pricing, for every $100 notional amount, we remove the upfront premium and quote, let's say the upfront premium here in this case, let's say the upfront premium is 1%, right? 1% into the duration, let's say 5 years approximately. So 5% forms the upfront premium. So the price of the CDS, it is $95 per $100 notional amount. So at any point in time, okay, this is at the time of inception of the CDS. But after the inception, based on how the reference entities credit situation changes, right? Based on how the reference entities credit situation changes, the spread may either increase or decrease. So if the spread is increasing, then it would profit the buyer. If the spread is decreasing, it will profit the seller. Spread is increasing means the company is the reference entity's chances of default are actually increasing more and more. So it would be a profit to the buyer, because the CDS buyer is anyhow bearish on the credit or the financial situation of the reference entity. So if the credit spread is increasing, the CDS buyer will receive a benefit. Credit spread is decreasing, CDS seller will receive the benefit. This is what typically goes as a part of the market pricing of the credit default swaps. Now, how does the credit default swap help the company in managing the exposure to credit? See, sometimes we also see people getting into buying and selling of naked CDS. Means they don't have the exposure to the underlying purchases protection at all. Whereas when we talk about a typical trade, the long short trade, this is one common trade that we see in the CDS market. The buying will happen on one reference entity and selling will happen on another entity. So in case of buying, you get you pay a premium regularly, and in case of selling, you receive the premium regularly. In some cases, you can even construct it such that the net is always zero. And there is one more improvised version in the long short trade where you do the buying and selling, but not two different reference entities. We talk about the same reference entity itself, but maturity periods are different. Means this is a company X bonds only, the reference entity is company X only, but probably I will buy based on a 5-year debt. I'll buy a CDS, and for it based on a 10-year debt, I'll sell a CDS. Why will I do that? When I am buying a CDS, it means I am buying protection. Buying a protection for a short term and selling the protection for a long term means in the short term, I am expecting a bearish outlook for the company's performance, which could impact the cash flows of the bond. So that's where I would like to protect myself for the short term, whereas I feel that after that, in case the company is fine in the short term, the returns can very well be reversed, and the company can go well in the long term. Whenever I have such a kind of short term bearish outlook, generally what I do is I buy the protection for a shorter term and sell the protection for a longer term. In that case, we call that trade as flattening trade, curve flattening trade, because from being steeper in the long term, I am expecting that it goes flatter. Whereas when I am looking at the other way, sell a short term CDS, because a seller of a CDS is always bullish on the company's position, whereas a buyer is bearish. So when I am selling a CDS, I am bullish in the short term. The company has no problem in the next 5 years. But probably when I look at for the next 10 years, there may be an issue. So in that case, it's always advisable to sell short term CDS, whereas buy a longer term CDS. So these kind of, then we call it as a steepening trade. So depending on how our outlook of the financial position of the company is, we can use the CDS to manage the credit exposure of the company. So these are some of the important things that are covered as a part of our understanding of the credit default swaps, right, wherein the basic understanding as well as the basic terminology used in credit default swap along with the pricing and the valuation mechanisms involved in it are given a brief overview in this session. I hope there is a clarity in all these aspects and you are able to appreciate the goodness of the credit default swaps much better. In case you have any further queries regarding the same, please feel free to get in touch with me by giving me a call on the number that I have given below, or you can even send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.